Welcome back to the Deep Dive. Today, we are tearing into the Q3 2025 earnings call for Sezzle Inc. That's S-E-Z-L. This is a really interesting one. A high-growth U.S. equity in the buy now, pay later space, and their recent performance is just a masterclass in market dissonance.
It really is a pivotal moment for them. And you have to remember the context here. This stock is, a high beta vehicle. It got pretty beat up, was down over 23% in the month before the call.
Right.
But the broader picture shows this massive underlying investor faith. The stock was still up almost 46% year to date.
That volatility is the perfect setup, isn't it? Our
Right.
mission today is to, synthesize the core financial beat because the numbers were frankly spectacular. But more importantly, we really need to dig into the strategic shifts management is making right now and then analyze these major high-stakes catalysts that are going to define their 2026 outlook. We're going deep on the why behind all these numbers.
Let's start with the immediate punch then, because, they just hit it out of the park. Sezzle delivered a milestone quarter, and the headlines were just huge beats.
A massive beat. Revenue clocked in at $116.8 million. That didn't just meet expectations. It sailed past the consensus of about $104.7 million. That's 67% year-over-year growth.
And the earnings. GAAP EPS hit 0.75 cents, just, substantially ahead of the street.
But the real story of scale, for me at least, is the gross merchandise volume, the GMV.
Oh, absolutely. This quarter, they hit $1.05 billion. That is their first ever billion-dollar GMV quarter.
Wow, $1 billion.
Yeah, representing a nearly 59% jump year over year. And for a BNPL player to be scaling at this rate while staying profitable, that is highly, highly unusual.
Okay, so here's where the story takes its bizarre turn. Those numbers drop after hours, and the shares initially pop, about 7.8%?
Right. A pretty standard positive reaction to a blowout quarter.
But that joy lasted about 12 hours. The regular session opens, the stock gaps up, and then just suffers this sharp, heavy intraday profit taking. It closed the day down 12.5%.
On roughly 3 times the normal trading volume. It was a massive move.
That's just fascinating. A huge revenue beat, a $1 billion GMV milestone, and the market punishes them with a double-digit drop. What does that tell you about investor expectations right now?
Well, it confirms 2 things for us. 1, expectations are stratospheric for these high-growth tech names. And 2, there is this persistent underlying caution. Investors aren't just worried about, competitive risks from the bigger guys. They're specifically concerned about credit quality in this higher rate environment. And that anxiety just outweighed the phenomenal performance.
That volatility brings us right into the heart of their financial health then. They claim they're achieving that rare combination of rapid scale and profitability. Let's look at the proof.
The margins, on the surface, they look fantastic. Yep, net income grew 72.7% year over year to $26.7 million.
72%.
Yeah, and that's maintaining a net margin of 22.8%. Adjusted EBITDA was also stellar at $39.6 million, which keeps them at a really robust 33.9% margin.
But if we look closer, the adjusted net income margin actually declined a bit. 200 basis points year over year. Management said that was due to, I think the quote was, aggressive high return spending. How do we know this isn't, the start of a credit cycle turning sour or just unsustainable marketing?
That's the critical question you have to ask, right? And management's defense, it really hinges on efficiency somewhere else. Yes, they deliberately cranked up the credit and marketing spend. They wanted to capture market share alongside that 67% revenue growth. But they highlighted that beneath the gross margin, they are seeing really strong operating leverage.
Okay, let's unpack that. Operating leverage, what does that practically mean for Sezzle, for the listener?
It means they're getting dramatically more efficient as they scale. So specifically, their non-transaction related operating expenses, things like engineering, corporate overhead, those decrease by 290 basis points as a percentage of total revenue. So put simply, for every new dollar of revenue they bring in, their fixed costs are just consuming a smaller piece of the pie. They're scaling fixed costs slower than their top line growth. And that suggests the business model is fundamentally sound, even if they're pushing the credit and marketing pedal right now.
Right, so they're trading. They're essentially trading a bit of margin now for that long-term structural efficiency. And speaking of capturing market share, the way they're driving user engagement has been extremely innovative this quarter.
Absolutely. Monthly active users grew 38% year over year. But the real star was the increase in revenue generating users. That jumped 120%.
120%.
Huge driver of that is their product innovation around retention, specifically the Earn tab.
We've seen other companies try to make their payments app a, quote, daily destination. How is the Earn tab actually working for them?
Well, it seems to be working through gamification and, essential services. The Earn tab has features like an arcade, Money IQ, coupons, and rewards for everyday spending like gas and groceries. Since its launch in late Q2, it's logged over 13 million visits.
15 million.
Yeah. And that fundamentally changes the relationship with the user. The app goes from something you only open when you need a loan to something you open daily for rewards and financial tools. That drives retention, and critically, it pushes consumers toward those higher lifetime value products.
That transition to maximizing lifetime value, or LTV, leads us right to the core strategic shift they talked about. They pivoted mid-quarter away from the on-demand product.
Correct. The on-demand product was great for driving initial engagement. It was frictionless, very easy to join. But management found that the conversion rate to long-term profitability and, the overall LTV profile of those users was less robust than they wanted.
So they just made a hard left turn, reallocated marketing dollars immediately.
Precisely. They shifted focus to drive subscription signups, and they boosted their total subscribers to 568,000 by the end of the quarter. Management is absolutely convinced subscriptions are the key to mixing that durable, predictable revenue and stronger profit profiles, even if it means slightly less explosive GMV growth in the short term.
We also heard a lot about heavy investment in AI. In this climate where every tech company seems to be using AI to cut costs, is this just a thinly veiled move toward layoffs?
Management was very, very careful to address this head-on. They insisted it's about enhancement and leverage, not cost-cutting by reducing staff. They centralized their AI leadership and rolled out a new support chatbot and an AI shopping assistant. The whole goal is to let them scale GMV faster than headcount grows in those high-volume areas, like customer support. They're layering tech on top of their people to make them more productive.
Okay, speaking of high volume and leverage, we have to address the credit portfolio. They intentionally broadened the underwriting aperture to support that billion-dollar GMV target. That sounds like a recipe for risk.
It does, and that decision showed up in the numbers right away. The provision for credit losses increased to 3.1% of GMV. That's up 70 basis points year over year, a measurable increase in risk.
So if they're deliberately chasing growth by lending to a slightly riskier pool, how can investors sleep at night? What assurance do they give that this isn't going to just, blow up in their face next quarter?
Their reassurance was twofold. First, they stated that the loss metrics remain firmly within their long-term targeted ranges. Second, they back this up by tightening their full-year provision target range to the lower half of 2.5–2.75%. That signal of confidence suggests they're controlling the risk factors very carefully, and you have to remember the fundamental nature of BNPL. The short duration of their loans means they have incredible agility. If the portfolio starts to deteriorate, they can pivot and tighten underwriting almost instantly.
A major benefit compared to a traditional bank. Let's zoom out to the bigger picture then. The investor context and these major strategic catalysts that could really re-rate the company. Their capital structure looks solid for now.
Absolutely. They're sitting on $134.7 million in cash, and they executed a really smart move on their revolving credit facility. They used the accordion feature to upsize the facility from $150 million to $225 million.
For those not deep in finance, what is that accordion feature doing for them?
It basically gives them built-in, pre-approved capacity to expand their debt facility without having to renegotiate the whole agreement. It provides necessary immediate capacity for future GMV growth, especially as they head into the holidays.
Okay, now for the two big ones. The high-stakes strategic projects that they invested $1.3 million into last quarter. These feel like the true structural game changers.
They are. The first is the near-term catalyst, the ongoing antitrust litigation against Shopify. Sezzle alleges Shopify is limiting BNPL choices for merchants. Shopify has petitioned to dismiss the case, and a decision on that is expected in December.
So very soon. A win there could dramatically expand their merchant reach.
It would be huge. And then the long-term, really expensive project is the exploration of getting a U.S. industrial loan company charter, an ILC.
That's the structural holy grail, isn't it?
It is. It's a time-consuming, expensive process. They're looking at an application submission in the first half of 2026. And the reason it matters so much is capital efficiency. If they get that ILC charter, it allows them to access much cheaper funding sources. It fundamentally reduces their cost of capital, giving them a massive structural advantage over competitors.
Okay, let's talk guidance. Despite all this volatility and these big strategic shifts, What confidence did they convey for the near future?
They reinforced some very high conviction. They reaffirmed their full year 2025 revenue growth guidance of 60 to 65% year over year, and they actually raised their adjusted EBITDA guidance to the $175 to $180 million range. And most impressively, they gave an initial 2026 guide for adjusted EPS of $4.35. That suggests sustained growth of about 29% next year, regardless of the bank charter.
The CEO also closed the financial commentary by positioning BNPL as, well, almost as a moral tool, arguing it's fundamentally superior to credit cards.
That's the narrative they're pushing, yeah. That BNPL forces responsible repayment and budgeting. That it actively reduces the risk of consumer overspending and bankruptcy compared to the revolving debt of credit cards. And industry forecasts kind of support the demand side of that, projecting global BNPL GMV will hit $560 billion this year alone.
Okay, we've covered the numbers, the strategy, the volatility. It is time for our high conviction segment. This is the part where we remind you that we are talk tickers, and this is not financial advice. But if we were pitching an outrageous but plausible trade idea, here is the thesis.
The thesis has to be built on that high beta nature and the discrepancy we talked about. A great quarter met with a brutal 12.5% sell-off. That was driven by generalized fear. That fear, combined with this dense catalyst map, provides what looks like a fantastic entry point.
And the stock is trading at a heavy discount. There's something like 17 to 18 times earnings, despite guiding for 60+% revenue growth. That just screams mispricing if management can execute on even one of those structural projects.
So the pitch is a hybrid approach. It's a long position in SEZL short-dated calls, specifically timed to capture the immediate pop from that potential December court ruling on the Shopify antitrust suit. That's your short-term kicker.
And the anchor for the position. What's the long-term play?
A paired long-term position betting on the success of either the ILC charter or the Shopify win. Success in the Shopify case expands their market access, re-rating the stock from a niche player to a broader payments platform. Success with the ILC charter structurally reduces their funding costs. Achieving either one should move the stock out of this speculative BNPL bucket and justify a much, much higher multiple. It's a bet on strategic execution using the current high volatility as your entry point.
That is a high conviction trade. It's built on the belief that strategic execution will eventually trump that short-term market anxiety. So what's the core takeaway here for the listener?
The core takeaway is a company that just delivered a record quarter, their first billion-dollar GMV print, 67% revenue growth, but which is deliberately accepting short-term margin contraction to secure long-term structural advantage. They're pivoting toward higher LTV subscriptions. They're leveraging AI for future scalability. This is a story of deliberate investment in efficiency and stability.
So what did this all mean for you, the investor, watching this stock ride these massive waves of volatility?
It means patience is paramount. The CEO ended the call by referencing Warren Buffett's first stock purchase, where he sold too early and missed out on the quiet miracle of compounding. The lesson is that for a high-growth, high-catalyst name like this, wealth comes from time in the market, not timing the market. These catalysts are expensive and they take time to materialize, but if they hit, the structural change will be huge.
An excellent thought to end on. Remember, the information discussed today is based on our analysis of the earnings call transcript and is for informational purposes only. It is not investment advice.
Always consult with a qualified financial professional before making any investment decisions.
We'll see you next time on The Deep Dive.